Joining us from Carolina Capital, and today we are going to be talking about some lending and having the best seat at the table. So before we get started, I do just have a couple of quick announcements for you guys, a couple of things we always kind of like to go through in the beginning of our webinars. So I promise I won't take up too much of your time, but we do have a lot of new people that actually join us every single week. So if you are not familiar with Quest Trust, we are a self-directed IRA custodian based out of Houston, Texas, and we basically teach investors how to truly diversify their retirement portfolios by learning how to invest their IRAs into non-traditional assets, assets such as real estate, notes, private placements. You can actually hold all of these inside of an IRA and get really awesome tax advantages, but there's just not a lot of people out there doing the type of education that we offer to really teach you about all of these topics. So I'm super excited to have today's guest speakers with us, but I do have a quick disclaimer that we always like to give at the beginning of our presentations. Please be aware that Quest Trust does not provide tax, legal, or investment advice. We are not your CPA, we are not your attorney. We are the go-to when it comes to answering all of your questions when it comes to investing with self-directed IRAs, but just please always be sure to do your own due diligence, work with professionals, don't rush into deals, and all of those kind of normal things that you hear in that standard disclaimer. So again, at Quest, we hold self-directed IRAs, but that's not really a specific type of retirement account. Whenever we say self-directed, that basically means that you, as the client, actually get to choose all of your own investments for your IRA. So there's a lot of various benefits to this. Like I said, it allows you to diversify your retirement portfolio. You actually have control over where your money is invested. Remember, it's 100% self-directed by you, the IRA account holder. But the most important thing here is that our IRAs get really awesome tax advantages that we do not get as individuals. So as you are going through investing in real estate, building wealth, and building up multiple streams of income, you want to make sure that your retirement plan and IRAs for both you and your family are part of that overall planning that you're doing for your long-term wealth. So if you're interested in learning more about this, be sure to reach out to an IRA specialist. I will have some information here at the end of my short few slides for you guys, but we actually do have 7 different types of accounts that can be self-directed. I don't have too much time to go through all of these, but reach out to us. We can help you figure out, if you have a 401k to roll over, if you're maybe looking to start a Roth IRA. Our IRA specialists are actually trained to go through these one-on-one consultations with you and really tailor this conversation to your personal situation. So reach out to us. We have a lot of options. If you're self-employed, you can make those larger contributions, and you can also self-direct a health savings account and a CoverDell as well. And you can actually use that money today completely tax-free for your health expenses and your children's educational expenses as well. Kind of like I mentioned, you have a lot of different options when you're investing your IRA here at Quest. We break it down into 3 different categories: real estate, private entities, and promissory notes. So today we are going to be talking about notes and private lending, and we do actually have a pretty big private lending event coming up in April as well that I'll touch on. But like I said, reach out to us, visit our website. We actually have a lot of great resources for you guys, no matter what step of the process you might be in. Be sure to reach out to us or check out our other resources that we have online. I do actually have Miss Sarah Shellum online moderating with us today, and she is going to be posting some links for you guys here in the Zoom chat about some of our other educational events that we have coming up. So this class is just one of many events that we host. Every single week we host multiple webinars with different guest speakers that we bring in from across the country. And as you can see here, we have a lot of great resources: our YouTube channel, our website, and I actually personally host our virtual networking happy hour twice a month. It is the first and third Wednesday at 6:30 p.m. Central Time. And not just because I host it myself, but this is my personal favorite event that we host right now. because every other week we get about 50 to 70 real estate investors from across the US that actually come online together for a Zoom meeting, and we all kind of network with each other. Everyone gets a chance to introduce themselves, and it's a lot of fun, and it's really built up this nice little community of us that meet every couple of weeks. So definitely be sure to check out those happy hours. And self-directed IRA Saturdays as well. We host pretty big webinars every single week, and you can find all of those on our website. Now, we do have a couple of large events coming up this spring. Mainly the two that we have coming up is our quarterly CE course that we host for real estate agents. We do host this a couple of times a year. We usually get around 1,000 agents that register for this from all across the state of Texas. So if you're interested in joining us for our next CE course, it gives you a deep dive into self-directed IRAs, all of the fun stuff that I don't really have time to touch on today. But if you scan that QR code, you can register very quickly right there through Zoom. And we also have QuestCon Live Private Lending Edition coming up in April. So QuestCon Live, since last year all of our events have gone virtual, we now host a pretty big online self-directed IRA conference. We've hosted 2 QuestCons back in 2020, and the next one we have coming up this April, and it is our private lending edition. So all 2 days of this event will be strictly over private lending, borrowing, lending, legalities. We're going to have some attorneys and our usual pretty high-level speakers that we bring out for these events. So tickets to QuestCon Live are in pre-sale right now. Be sure to head on over to our website to get those. And as always, if you have questions, be sure to reach out to us. You can chat live with an IRA specialist right there through our website, or you can give us a call, or you can send us an email. We are very easy to get a hold of. Not going to leave this on the screen up too much here, but if you're interested in setting up a free consultation, scan this QR code. I hope everyone else likes QR codes as much as we do. It makes things really easy. But reach out to us if you have any questions. All of our contact information will be there in the chat. So Juan, if you could help me unshare my screen. Yes. So without further ado, I want to go ahead and get into today's main presentation. We have Bill Fairman and Wendy Sweet here. Bill and Wendy, I'm so excited to have you guys back, and go ahead and take it away, and I'll come back on at the end and we can do some Q&A from our attendees.
Thank you, Haley. It's great to be back. I know I haven't seen you in a while, so it's great to see you. So you are live, but you're not in person.
Yes.
By the way, going back to the QR code, there's a building in Charlotte where we're sort of located that has the Guinness Book of World Records for the largest QR code. They painted it on the roof of the building, and I saw it from Google Earth.
Oh,
just a fun fact. Okay, thank you so much. I'm going to go ahead and share our screen to get started.
All right.
Gotta hit play. Okay. Once again, thank you very much. I am Bill Fairman. This is Wendy Sweet. We are with Carolina Capital Management. We're not just a private lender and a fund manager, but we're also Quest customers. So
yes, we are.
We personally have several of our IRA or tax exempt or cash tax-free accounts with Quest.
Yes, we do.
They're an awesome company. So we're going to talk about the lending side of the equation versus owning the property. But first, we want to talk about who we are and why we're qualified to talk about this stuff. We have a combined mortgage lending experience, and I keep saying this because Wendy's so much younger. She only has like, what, a year and a half worth of experience, 50 plus years. Wendy's a licensed real estate broker in 2 states, and she's been that way. I know it says 30 years.
1981. That's
again,
a long time ago.
Again, she started when she was 12.
That's right.
We've operated successful lending, private lending company since 2011. We've managed a private pool mortgage fund since 2014.
Mm-hmm.
And this is the most important part. We've been active investors ourselves for 20 plus years.
That's right. We too have lost money in the real estate industry. And if you haven't lost money, then you're not doing enough, right? That's not the goal, though.
That's right. So, Wendy, why don't you take it away and tell people how do they become the bank?
Yes.
Because, by the way, one of the biggest benefits of having a self-directed IRA is that you direct the investment.
That's right.
One of the disadvantages of being in a self-directed IRA is that you have to do the investment.
Yeah. Well, your due diligence for the investment.
That's
for
right.
sure. So we are a bank, and I can even remember when I first started in this business, which was I always say that I started out as a recovering mortgage broker. I had a mortgage company, and we only did investor loans. So I got really good at investor loans, and I really accidentally fell into the hard money industry, because that's what we do, is hard money. Kind of fell into it, doing it by accident, because I had people that would qualify for loans, but they couldn't find a house. And then they had money. And then I had people money in their self-directed IRAs. And then I had people that couldn't qualify for a loan for what they were looking for, but they could find all kinds of houses. And I started really putting those folks together. That's really, really how I got into the business. So then I learned that it was called hard money and private lending. And I'm thinking, wow, these people have all of these self-directed IRAs that they're just sitting there. They're not putting them to work. So that's how I got started. I didn't have a whole bunch of money to lend. I used other people's money. So you don't have to have money to get started in this business, but it helps, especially if it's in your self-directed IRA. You can know other people that have money in their self-directed IRAs, and that's what worked for us. Got it to a point where we really had $23 million worth of self-directed IRAs from people across the country that invest in loans, in the hard money loans. Now, we do all the heavy lifting,
Sure.
But you can do it. You can use your own self-directed IRA, or you can help other people that have self-directed IRA money to help them lend that money too.
Now, keep in mind, and I want to go back to Haley's disclosure.
Yeah, we're not.
We're going to ditto her disclosure.
Yeah.
We don't give legal tax advice or tax or legal advice.
That's right.
Legal advice.
But we play attorneys on TV.
That said, inside of your IRA is not to benefit you; it's to benefit your IRA.
That's right.
So anything that you do with investing, real estate, whether it's lending, whether it's owning apartment buildings, whatever, it can't benefit you, and you have to make sure that you're not going to be considered a business.
Right. Right.
So if you have other money to lend, or you have money to lend, that's great.
Mhm.
You know other people with money to lend. You guys can do some deals. Just be careful you don't do lots and lots and lots of deals, because the IRS might consider that.
Well, and then you'll have a whole full-time job at it as
Yeah.
well, because there's work to it. And
Listen, I know people that have a full-time job doing their IRA, but they do it because they love doing it.
that's right. And the other thing too is, you really need to take advantage of the people that work at Quest that can help tell you what's an arm's length transaction and what isn't, because you can take cash and couple it with your self-directed IRA, but you can't touch it. And there's a lot of things you need to know to keep you in the black and white areas of what you can and cannot do using your self-directed IRA. Quest can really show you exactly what you need to do to make it a really sound investment, and with no questions from the government on it. So to have deal flow, or to know others with access, becoming a bank, you need to know who you're going to lend to. So here's really that's probably the biggest question I get when people say that they have money that they want to lend out. Well, how do I get it out there? The first thing I tell everybody is to join your local real estate investor group. That's really, really important, because that's going to give you exposure to investors. Not only exposure to investors, but it'll give you an opportunity to get to know them. Now, for me, I would go to all the individual subgroups that my local RIA group would be putting on, real estate investor group. I would go to the subgroup, because that's who you're breaking bread with across the table, having a drink across the table. You're getting to know them. You know what kind of business they do. You know how did they do on their last deals? You know who they're doing business with, the quality of the product that they're doing. You want to make sure that you're lending to people that you know, like, and trust. So having access to those people is great, but really getting to know those people is even more important. And, you know, Haley was talking about the events that she's putting on, the one that she hosts twice, is it twice a month that she's hosting those, the cocktail events, virtual cocktail events. That's a great way to get to know other people who have self-directed IRAs too.
Networking is very
important.
important.
That may be looking to borrow your money. So that's a great way to get to know people. You got to get out there and ask questions and get to know them, and they need to get to know you as well. What's the next?
Yeah, well, I was going to add to that. Now we kind of stay in the short-term lending space ourselves.
It's our favorite spot.
And the beauty of short-term lending is that they tend to be higher yielding, or you get a higher return.
Right.
The downside to short-term lending,
you got to work at it.
Short
term loans.
because they pay off quickly, and the last thing you want is your money not doing anything.
That's true, but it gives you an opportunity to really get to know who you're lending to or borrowing from, and you know how they're getting in their process from start to finish in their process. So you've seen it begin and end, and you can grow more comfortable with who you're dealing with.
Right. And you're not making a long-term commitment. That's another thing. There's advantages of making a long-term commitment, and there's disadvantages of long-term commitments. Because, let's say, for example, a 30-year mortgage loan.
You're stuck.
If you're lending on a 30-year mortgage or a 20-year mortgage or a 15-year, and, the rates end up going up while you're into this, you're locked in. With a short-term loan, you don't have any long-term commitments, and you can go as how the market is lending itself.
That's exactly right. Being willing to learn is everything. And obviously you are willing to learn, or you wouldn't be on this webinar to begin with. All of the things that Quest has to offer, all of the different options for the different webinars, and being able to go back on their website, and listen to what's been recorded in the past. You cannot learn enough of what's out there and the options that you have. And every time you watch it, if you watch it again, you're going to learn something different that you didn't hear before. I promise you, real estate is always changing, and every deal is always different. And somebody's been through what you're going through, or has been through what you're about to go through. So you need to learn everything that you can. And the more that you understand IRAs and how they work, the better off you're going to be, and the better off if you're loaning money with someone else that has a self-directed IRA, the better you're going to be able to help them make smart decisions on what they want to do. It's really, really important to be willing to learn.
Yeah, the real estate industry itself is always evolving, because it's cyclical, like most things, and things are changing, and not just the industry itself, but there's a few moving parts when you're making a mortgage loan to someone, and you need to be able to, and the most important thing is protect yourself.
That's right.
By having all the proper documentation to make the decision, the proper documentation and the closing. And again, don't worry about what is the cost of an appraisal, what's the cost of closing, hiring an attorney, doing all the title work.
What does it cost if you lose it?
Well, let's put it this way: who's paying for all this?
That's right. The borrower is.
Right. So you as the lender, you're not paying for any of this stuff. Your borrower is, but this is documentation and due diligence that you have to have.
Absolutely.
So one of the things we like about the lending space is that you can control the asset without being responsible for the asset.
Woohoo!
I mean, what better place is there than that?
No responsibility.
And part of that is you have also less exposure than the owner would. Why is that? Well, typically because you're not loaning what that person is paying for the house.
Right.
So we call that you have cushion.
Right.
This is why we have this lovely picture of a lot of cushion. So,
Makes me want to lay down.
for example, we make loans on single family properties that are not going to be any higher than 70% of the market value after, and we do a lot with construction,
The after
rehab. So we're looking at the after repair value, and we're not going to go more than 70%. Again, keep in mind, if you're listening to this and you're thinking, well, wow, that's 30% profit I could make if I ended up having to foreclose.
Yeah,
Wrong.
Yeah, doesn't happen that way.
That's not what the cushion is for. The cushion is there to keep you from losing any principal. You cannot, if you foreclosed on someone, for example, and you sold that property, you can't keep any proceeds above what they owe you.
Mm-hmm.
You have to give that to the person that you foreclosed on. Now, you can collect all your reasonable fees, late fees, attorney's fees, all that kind of stuff.
Mm-hmm.
But you can't make a profit on a foreclosure. That said, if they sign it over to you in what we call a deed in lieu of foreclosure, in other words, I can't make these payments to you, but I'm willing to sign this property over to you if you like, and you won't have to go through the process of foreclosure. Then if you sell the property at a profit, then you get to keep all of it.
But you need to remember this. Is the property finished? Are you going to have to go in and finish up the rehab part of it? That 30% that you think is cushion can dwindle really quickly when you start adding real estate commissions and all the overages that you didn't expect on the rehab. There's a lot of things that can happen, which is why we're saying that it's best to be the lender, because that's not your responsibility. But once you get a deed in lieu signed over, now it's your responsibility because you're the owner of it. So everything changes at that point.
And this is why it's important to know who your borrower is, know, like, and trust, have all the information that
and
you need
to
to
notify Quest and let them know that you're now the owner, because now it's a different type of transaction. So you have to fill out a little bit of paperwork for that.
So one of the other things that you're not responsible for are local taxes, like property taxes. Municipalities have some fees, and it's funny. It used to be all fees. I mean, all taxes, but the municipalities, the city council people, they wanted to continually get reelected, and by saying, I'm not raising your taxes,
they'll add a fee.
So they added a fee in lieu of taxes.
That's right. It's not tax.
And now they can say it's not tax. And oh, by the way, it's not deductible either.
That's right.
But again, you're not responsible for those. The person that bought the home is. Insurance, maintenance, and management. That's another thing. Again, if it's a rental property and you're the lender, you don't have to worry about toilets, trash, and tenants. You do have to have insurance on the property, or your borrower does.
With you as the mortgagee.
It should be maintained, again, but you're not having to manage it or maintain it or have to deal with the insurance. Regulations and liabilities. We're heading into more regulations for sure.
Yeah, just a bit.
And when I talk about liability, I'm talking about if you own a property, and obviously you have a blanket liability policy on it other than the property insurance. And why would you do that? Well, we're a very litigious society. So what happens?
Like to sue people.
That's right. We trip over the step, try to get in and skin our knee. That's worth 50 grand.
And it's everybody's fault. That's right.
But I have never heard of a lender being sued for something that happened on the property.
Right.
It doesn't make sense. No one's going to do it. They're going to sue the owner of record.
That's right. Who is usually the builder or the rehabber.
Right. Okay. Here's another thing that we like, because again, you're controlling the asset. I love this picture. This was, I think, a 2008 Super Bowl commercial where the little kid was trying to control every object with his mind, wearing this Darth Vader outfit. And Dad started the car up with a key fob out there, and it really freaked him out because I can actually do it. All right. So as the creator of the note, you can add restrictions. What do you think? What kind of restrictions can
not allowing a second position lien behind you without written permission is one. That's probably my favorite.
Well, I like some of the restrictions on the use of the property.
Yes, absolutely.
So let's say,
No
for
owner
example,
occupied.
well, if you're lending, and I always recommend this, you really don't want to lend on somebody that is going to live in the property.
Right.
Why?
Usury laws.
Because now you have to start qualifying under the Dodd-Frank stuff. But if you lend to another business for business purposes, you're exempt from all that.
That's right.
But at the same time, you want to make sure that that investor isn't going to change the value of that property somehow adversely.
Right.
So if it's a single family property, maybe it's a bigger one, and they're supposed to do a fix and flip, or maybe they're doing a fix up to hold, and it's a single family and its own single family, but it's okay to have a boarding house there. Is that the best use for the property? Is that the highest and best use for the property?
Good question. Sometimes yes, sometimes no.
So you can restrict and say this can only be a single family unit. It can't be broken up or subdivided or turned into a duplex or a boarding house or a halfway house or whatever. You have that control. And basically that control says if you find out that kind of thing happens, you can call the note due and payable.
Well, the other thing too, I think that's really important for lenders to know is that you, the lender, is the one who comes up with the rate. You, the lender, are the one that comes up with the term. How long am I going to lend this for? You, the lender, are the one that's going to decide whether or not you're going to charge points and how many. You don't let the borrower name the price. You're the one with the money, and he who has the gold sets the rules. So make your rules work for you.
Correct. There's other things that you have rights to as part of that hazard insurance that's on the property. You have to sign on anything that if there's any damage.
Right, because you're the additional insured, the mortgagee.
So you not only have restrictions on the note, but you have rights as the additional insured as part of that property. It would be title insurance as well as because you have, with title insurance, you have a lender's policy and you have an owner's policy. That title insurance protects you if there may have been a break in title down the road and a previous owner or a previous heir may come back and say, hey, I was never informed that, this property was sold and I have rights to it and blah, blah, blah. That's okay because you have title insurance on it now that the attorney drew up, and the title company has the insurance policy. So they'll pay that. They're not taking your property and giving you the money.
Right.
They're giving that other person the money.
That's right. That's right. And
they'll settle with them.
Quest, your account in the name of Quest would be that mortgagee clause.
Or if
fire,
if they lost in court and they did take the property, they're making sure that you're
compensated.
Yeah, compensated.
Tough word.
Yeah, I know. Good thing. All right, lending from your IRA. Here's the great thing about lending from an IRA. There are no tax advantages to interest income. It is going to be totally taxed as ordinary income. So that's why you want to do it
in your IRA,
in a tax deferred or a tax exempt account, right?
Absolutely. So it would be your HSAs, your ESAs.
Every one of those accounts that Haley was showing on the screen, you can utilize
the 4 or 5 pigs she had up there
in a loan.
That's right.
Lending is less likely to be considered a business. Now, we talked about that earlier. If you owned an apartment complex or you started owning a whole portfolio of properties, maybe you're up there to 20 or 30, even though you have somebody else that's managing it for you, that the IRS may consider that a business.
That's right.
And there's a little thing called UBIT tax. They might add to that. And I'm pretty sure you don't want that again. Consult with your tax attorney. I'm not one of those.
That's right.
But lending is less likely to be considered a business.
Depending on how many loans you do.
Well, yeah,
And that's a gray area.
It's real gray. I think they've come up with some new recent tax memos. I don't know what you call them, but they have changed little things since Trump's tax changes. They added something in there about you can't spend more than 100 hours a year in your passive investment before it becomes an active investment. Okay. So keep that in mind. I'm always thinking that the most I'm ever going to spend in a year in my passive investment is 99 hours.
They can always use a company that brokers that stuff.
That's right.
Like, I don't know, us.
You're not likely to have ongoing expenses.
That's right.
So again, if you hold physical property in your portfolio or in your IRA, there's going to be maintenance.
That's right.
Taxes, all kind of upkeep. You're going to have money in your account to cover those things, which means you have money working for you.
That's right.
It's there in the reserves to pay for these ongoing expenses.
Yeah, expected and unexpected, both.
Unexpected?
Unexpected.
We do this a lot. Wendy and I talk quite a bit, and sometimes the words don't come out like they're supposed to. Of course,
Thank you for pointing that out, Bill.
Well, that never happens to me. So if you're lending, there's very. I'm not saying it's not going to happen, because let's assume you did have to take a property back and you had to go into foreclosure.
That's right.
You're going to have to pay attorney's fees and upkeep of the house and all that stuff while this is going on. Now, keep in mind, if it's in foreclosure, you can't pay squat on that house. You can't go in there and do anything to it.
That's right.
It has to sit there until you actually have the property back.
That's right.
That's why there were so many neighborhoods complaining during 2008.
Right.
All these houses sat there and were eyesores and weren't kept up. It's because, if the bank started foreclosure, they still can't do anything to these things. All they can do is secure the property.
That's right.
They can only board up the windows, and that's it.
Yeah, but please, we've talked about that since we've been on today. We've talked a lot about foreclosure or taking a house back and all of the nasty things that come along with being a lender. But we want you to know the ugly. Yeah, you need to know the ugly. Do we expect things like this to happen? No, but you always need to be prepared for it. That's what's really important.
Yeah, the average private loan or hard money loan, there's a less than 2% default rate.
Yeah.
Okay.
But you need to be prepared.
You need to understand that there's always you always need to look at the downside, even though you have a really good upside.
That's right.
All right.
That's right.
So again, the ongoing expenses is important, because the last thing you want to do is have money that's not working for you in your account. And we'll touch on that a little bit when we talk about getting into lending funds. So one of the other things we love about lending is there's more exit strategies than owning a property.
Yeah.
Right?
How do you get out of this mess?
Well,
you can sell the note, and that, that's a whole great way to invest your money in the first place, is just buying notes that are already made for you to just buy through an assignment and a launch. Or you could sell the note that you're already in, and you can choose to sell the whole note. You must have a slide for that.
I have a sentence for that. What I wanted to mention is that when you own solid real estate, you have two options if you need the capital. You can sell it, or you can refinance it.
That's right.
If you finance it and it's in your IRA, Now you've leveraged your IRA,
Mhm.
and now again you're subject to a UBIT tax. Now, UBIT taxes aren't always bad.
Right,
Okay,
right.
I don't want to say that, because there are great strategies for leveraging your IRA, and
The UBIT
the
certainly doesn't
depreciation
outweigh.
could be
Yeah,
offset by the any UBIT that you would have to pay,
that's
and
right.
the UBIT is only based on the actual profit,
That's right.
not the entire asset
That's right.
value. So again, consult your tax attorney and legal advisor.
That's right.
You can sell a piece of the note.
Oh, I see.
Talk
I have
about
a
that.
sentence for you. So that's what's really interesting too. If you wanted to get some money back into your IRA to be able to lend to somebody else, you can sell the whole note. You can sell a partial of the note. You could sell the first 20 payments, the first 50 payments. You can sell the last part of the note if you'd like to. You can even sell part of the note in between the beginning and the end of it. So there's all sorts of things you can do to get rid of that note or to sell that note, and it doesn't have to be. You can even sell a partial note to where they're getting half the payment and you're getting half the payment.
Yeah, and I was going to try and point that out too. You can sell a payment stream.
Yes, yes.
So you can say, I'm going to sell, let's assume you had a 20-year note.
Mm-hmm.
I can sell you the first 5 years of the 20-year note, and I keep the last 2.
Right.
Right.
Mm-hmm.
Or you can sell somebody 20% of the note, and both of you are getting payments.
Right.
It's just split between the 80% and the 20%.
For the entire term. Right.
Here's another strategy. You can collateralize the note.
I like that.
Again, if it's in your IRA, you may be subject to UBIT.
That's right.
But what you're doing is you're, in this case, you're going to borrow money against the payment stream on the note. You're not selling the note. The collateral is the payments that you receive.
Mm-hmm.
And then obviously, if you don't send those payments to that person, and this is easy to do, you can, if you have notes, you want a servicer to collect it.
That's right.
And you can just, send a note to the servicer telling them to send this person the payments on this. Excuse me. Assuming you have collateralized the note where all the payments are going to that person.
Mm-hmm.
All the payments don't have to. They can go some to you and some to that person that you collateralize that note.
Right.
So you can borrow against the income stream. So let's talk about the different opportunities, active and passive, and real passive, semi-passive, and very active.
A little more passive, a little less passive.
So on the active side of things, you can be the private lender.
That's right. And that's where, that's where most people start, is you being the private lender. And
actually, where most people should start.
Yeah.
If you don't already know how to do the lending piece.
That's exactly right.
You need to get with somebody that's already doing the lending and invest alongside of them.
That's right.
So we were talking about buying a piece of a note. Well, let that person who is very active in this space
Mm-hmm.
and understands it, and say, look, I'll put in 10 or 15% of the note, and just kind of show me how it's going. I'll provide some of the money, and then you can do that.
That's right. And to do that, it's really, really important for you as a private lender to understand how a deal works.
Right.
You need to understand, is the house the deal itself? Are they in at the right numbers? The other question is, are they in a position to get refinanced out of your note in case they can't sell the house? So the more you understand about investing and lending, the better you're going to be as a lender, and the safer you're going to be as a lender.
And that's why it's important to get with a mentor or someone who has already been down this road a few
Mm-hmm.
times,
Mm-hmm.
and you're going to lend alongside of them.
Yeah,
Great
way to do it.
They're going to teach you how they arrive at their underwriting decisions, their the risk management
Mm-hmm.
of the decisions that they're making.
Right.
And who are they going to lend to? That can be very important.
Absolutely.
So you can get less active in a loan and still be a direct lender by lending on a longer term note.
That's right.
Now, again, the disadvantage is rates may change. It's an advantage if they go down.
Right.
While you're in a longer term note.
That's right.
But rates may go up, and you're not maximizing your returns that way. But at the same time, as long as they're paying, you're not actively having to find new places to put the money.
Remember, if it's sitting in your account and it's not earning anything, if it's not invested, you're earning a big fat zero.
Actually, you're earning less than zero.
That's right.
Because you still have fees you have to pay.
That's right.
And you're not keeping up with the rate of inflation.
That's
so
right.
That dollar you had today is not nearly worth as much tomorrow.
Right. So get it out there.
Now we're saying all the same things from the private lending side on the note banks.
Yes.
There are plenty of people out there that have notes to sell, and you have to do basically the same due diligence as you would be doing by underwriting the borrower and the property and everything else.
It's important to know the area, to know the house, the shape that it's in, what's going on in the market.
Right.
All of those things are important.
Now, the due diligence is a little bit different when you're buying existing notes, because you're not just comparing the loan amount versus the property value. Excuse me, but you're also looking at the note kind of divided into the value, because if that person's already paid 5 years, they've knocked down a certain amount of principal.
That's right.
And now you're buying it at a much lower percentage of what the actual value is. So, assuming values are going up, principal payments bring the note down, you're going to be in a much safer position buying an existing note. Again, if it's the right borrower.
That's right.
Again, typically note buying is buying consumer debt.
Yes.
Not commercial.
And make sure the paperwork has been done correctly when you're buying a note.
Right.
You need to make sure that they've done the good underwriting on their end, whoever you're buying the note from. If it is an owner occupied note, did they comply with the Dodd-Frank?
Yeah, so that's important. What Wendy just said is very important. You do not have to comply with Dodd-Frank because you're buying an existing note. You didn't make the note, but you want to make sure that the person that made the note is complying.
Right.
Because it makes it a less saleable product if you want to sell it later.
That's right.
And if you have to go to the foreclosure process for any reason, and those items weren't taken care of, it's something else for a judge to say, oh no, you can't do this because
it falls on you.
They weren't.
You didn't play by the rules.
They didn't comply in the first place. Are you scared enough yet? Now, here's your semi-passive opportunity. So you call it managed private lending. There's plenty of companies like ours. We're not the only one where we originate notes and then we end up selling some of these notes off.
Right.
Or we'll partner with folks. Some of them require you to be an accredited investor. Not all of them do. It just depends. And then the same. You want to talk about a little bit about that side?
I think you covered it all. The managing of the loan is, somebody else taking all the legwork out of it for you. And there are plenty of good people out there that do that.
Well, and I'm going to go ahead and talk about the note buying. It's the same thing. So that said, on the managed side of things, you still have to do due diligence. You want to do your due diligence on the borrower, because they'll have that information. On the property, is this something that you think could be sold? And by the way, if you're thinking as a banker, this is the most important thing to think about. Every time you look at a deal, is this a deal that if I have to take it back tomorrow, how quickly can I sell it?
Always.
Not how much money can I make on it.
How quickly can I sell it?
How quickly can I sell it, get the money back, get my money back out and invest it again?
That's right.
If you're not getting paid, you're not making any money.
That's right.
Or your IRA is not making any money. And it's more important to get that money reinvested than it is to try and make a profit on it, because you're losing the opportunity to make money while you're sitting on this, waiting for the disposition of the property. And if it's a property, we play in the affordable housing space, and I really suggest to everyone who is looking for downside protection,
Yeah.
to play in the single family affordable housing.
Yeah.
The reason we do this,
It's
and
just
the
a lower
reason,
risk.
and the reason you would want to do this is because in any economy, no matter what, there's two things you have to have:
Place to live.
and food.
Yeah.
Food and shelter.
That's right. That's right. And so it's recession resistant.
Mhm.
And the other thing about using a company that's going to manage these for you, manage your private lending or manage your, helping you to pick out notes and things like that. You need to trust the company, get to know the company that's managing that. That's just as important as doing your due diligence on the property and the borrower. You need to do your due diligence on the company that's doing that for you, because there are a lot of really good ones out there, but there's also some that you shouldn't be doing business with. So just make sure it's somebody that like, and trust.
And I'm just going to go back to the speed of being able to settle an exit strategy. Let's assume it's affordable housing. In our area, affordable housing really is $350,000 value and under. Every market's different.
Yeah, we're in the Carolinas.
Yeah.
Anyway.
So if you had a $1 million house and you had to start foreclosure or take it back, how quickly do you think you can sell that place?
Not too soon.
The affordable, not only do the affordable housing side of things are the most liquid, and it's because it is the most popular.
Mm-hmm.
First time home buyers want them. Empty nesters.
Mm-hmm. And investors. That's right.
And you're limiting your buying public when you get outside of that range.
That's right. Keep it vanilla.
That
Keep it plain.
The old thing that I learned, many years ago in the mortgage business is the least risky property
Mm-hmm.
is the median house for the area.
Mm-hmm.
In a subdivision with 2.5 kids playing in the
All the
yard.
houses look alike.
And anytime you got outside of that on either side, I mean, if you go down to a $20,000 house, it's just as hard to sell as $1 million
exactly
house.
Right, because nobody can get a loan for that little of amount.
Yeah,
not everybody has that cash.
Everybody would have to pay cash, and
that's an investor who's going to buy.
And let's assume it's not going to be in the best neighborhood,
right?
Or it might not even be in a neighborhood.
That's
it might be really hard to get to because it's
out the middle
30
of nowhere.
miles outside of town.
That's right.
That said, here's your third exit strategy. If you're having to take them back and you can't sell the property, it's renting them out.
Oh, I was thinking you burn it down. But...
So we'll call that the fourth strategy.
Yeah.
Again, we are not professional
fire people.
arsonists.
Okay. Yeah.
Consult your tax professional.
Consult your local fire department.
Okay.
Just kidding, really.
Anyway, the last strategy is if you can't sell it,
what can you rent it for?
You can rent these things out, and you can rent out a affordable home much easier and a lot closer to what your expected return would be. Then again, we go to that $1 million house. You can't rent out $1 million house and get the same kind of return you were getting from your loan.
That's right.
And why would you do that? I don't want to own property. Why would I do that? It's not as tax advantaged in my IRA as it would be if I had it in cash.
Right.
Well, it's a strategy. The house is only worth so much. If you're in a market where you have to take it back and you can't sell it, and the house is perfectly rentable or livable, there's a reason you can't sell it. It's because the market has changed.
That's right.
And everyone's a seller and no one is a buyer. We proved this in 2008. The values will eventually come back up.
That's right.
So you just collect rent. You don't worry about it. Collect rent, hire a management company, get some more mailbox money until the values come back up, and then you sell it.
That's right. You haven't lost.
Okay. Now, manage. Yeah. Okay. I'm speeding up. So a management company is going to, or manage private lending. They're typically going to take care of finding the properties, underwriting the properties. They have underwriting the borrowers.
Take care of the exit strategy.
They're going to service the loans for you. They're going to do all that, and it's going to be semi-passive. You still have to do the due diligence on each individual deal.
That's right.
But not all the other stuff. Now, if you're in fund investing, that's purely passive. Your due diligence is on the management company, their track record, and their understanding of their markets and what they invest in. Not all funds invest in the same thing. You have to read those PPMs to make sure you know exactly what their investment strategy is.
Don't just skim through it. And the waterfall is something they need to pay attention to, right?
Yes, that's how you get your money back, especially if things go south and everyone's a seller and no one's a buyer.
That's right. That's right. Who's getting paid first?
That's right. All that said, if you are one of those people, and I say this with no hard feelings, if you're a micromanager and you can't give up any control, do not invest in a fund.
Especially ours.
Anyone's fund. Yeah. Because you're going to drive yourself crazy.
Yeah.
And you're going to drive the
fund manager crazy too. Yeah, it's just not for you.
It's not in your DNA.
That's right.
To be purely passive.
Right.
But there's a lot of people that don't want a part-time job, and they're happy to do this. And let's talk quickly about the advantages of direct lending versus purely passive fund investing. You want to? You got a few minutes?
We've got, let's say, 4 minutes.
Yeah. Okay. So a benefit to obviously direct lending is that you get to choose the deal. You have a direct lien on the property, right? And then there's no long-term commitments, unless, of course, you make a long-term loan.
That's right. So don't do that.
So that's up to you.
You can do that. You can do that all day long. It works very well for some people. Yeah. It's just not an arena we like, because we like to be able to switch the game when the game changes.
Yeah, absolutely. You want to cover the disadvantages?
Your large amount of funds in one asset.
Yeah, so all your eggs in one basket. You have a chunk of change into one loan, right?
Right.
Unless you're partnering with somebody.
That's exactly right. And you can do that. You can partner with other people on the same.
But typically in an individual loan, you're making the loan on the whole property, right? What else? So
no compounding opportunities, and that's an important thing to know.
If you're in an IRA, you're probably not taking income. Right. Now, that's not to say that it doesn't happen, because I have individuals in our fund who are at the age where they have to take a minimum distribution. So they want the income every quarter paid out, because they have to take that out. But if you have a single loan and they're making monthly payments, those monthly payments are going into your account. And what are they doing when they get into your account?
They're not making any money, because they're sitting there uninvested.
They're turning into your reserves.
That's right. Which isn't always bad either.
No, but they're there and they're not invested, and you have to wait until you have enough money to make another loan.
Reinvest it. Right? That's right.
And then what else happens when you have your individual loan?
Is it lazy money that you're talking about?
Well, I'm talking about a gap.
Oh.
Because when we were, and yes, that's lazy money.
It is lazy money.
So when we talk about the gap and the lazy money piece, what we're talking about is, again, we do short-term loans, and we recommend those for most folks. The loans will pay off.
That's right.
And
you got to find a new one to put it in. That's right. And how long does that take?
You don't know.
Yeah.
It could be a week. It could be 2 months.
Yeah. We've got some borrowers that are lenders, that when they have a loan coming in that's going to get paid off, they already have it placed in the next loan. They're working at it.
Listen, it's a balancing act.
Yeah, it really is. It's a job.
What happens if you're expecting a payoff and
it doesn't pay off?
See, your current borrower is selling a house, and for some reason the buyer of that house, their mortgage company has put them off for another 2 weeks or 3 weeks. And now you can't lend money to the next person who needs to close on this deal right away. Right. that becomes very stressful.
Yeah, it is stressful, and it happens a lot more than you think.
Yeah. So, but as you, the lender, you, the bank, you don't want those gaps because it lowers your APR.
Yeah.
So if you had, let's say, for example, 11% return or 11% interest rate, and you missed 2 months out of the year in payments, you're really at 9.25.
Yeah. So it can affect it.
It makes a difference.
And I think we're at the end of our
Well, we'll
time
go
limit.
Real quickly. We'll run through the benefits of being in a fund. You're diversified across the entire portfolio. Remember, we talked about putting a chunk of change into one asset where you're not doing that in a fund. It's spread out. But your funds are always working. Once you're in a fund,
That's right.
it's always working. You never have to worry about loans paying it off.
Or that gap.
Yeah, and you can compound. The downside to being in a fund, it's a longer term commitment. Most funds are anywhere between 2 years and 3 years. You have to stay in the fund, or you have to pay a early withdrawal penalty.
That's right.
You have zero control again if you're a control freak.
That's
You don't wanna
right.
be in there. It's not as liquid, and it's not as liquid again because all these loans are out working, and if you need your money back right away, you can't go to the fund and say, hey, you need to call some of these notes due because I need my money back.
That's right.
You have to wait until a loan pays off or new people put money in.
Yeah.
Now, same thing with if you have a note, you can't turn around and tell your borrower to pay you off because you need to do something else with
That's
your money.
right. That's right.
So it's the liquidity is a little bit different, and you must qualify.
Depending on what fund you go into, because there are funds out there that you don't have to be accredited.
But I can tell you that most fund managers aren't going to choose the fund profile that allows non-accredited investors in it because they're not allowed to advertise.
That's right.
If they have non-accredited investors, they can only be people that they're already doing business with or have some kind of a business relationship with. So most fund managers who set up a fund are going to choose the one that requires accredited investors because they're so worried they're saying the wrong thing on, say, a webinar. And then have the SEC jump all over.
That's right.
So that's our information. If you want any, if you have any questions for us later, Wendy at carolinahardmoney.com, and don't email me. I never answer. I'm just kidding. Bill at carolinahardmoney.com, and there's our website, carolinahardmoney.com. That's pretty
hard to remember.
Yeah. Thank you, Haley. Let me share my screen.
Yeah, awesome.
Or I could just say stop sharing.
I
Right?
love the honesty
what
at the end. Yeah, we don't see your screen anymore. We do have a few questions from our audience, though. If you guys have a few minutes, we have a few questions if you want to do something.
Absolutely. That sounds great.
Awesome.
Perfect.
If I can get this screen out of the way.
Yeah, we've lost you. There we go.
All right. I can answer questions and look stupidly at the screen until I get my camera back.
Perfect. So, guys, if you're out there and you do have questions, feel free to go ahead and send them to the Q&A box. This is a good one. It came through kind of in the beginning of the presentation. But could you explain a little bit further about how you cannot profit from a foreclosure? What if it's worth more than you lent when a reforeclosed? What happens with the excess?
Yeah, great question.
Well, by law, you can only collect what's owed you. And so you can collect late fees if your note has a defaulted, what's called a defaulted
fees
rate. Well, it's called a default rate. So you don't see this in residential, but you see this in commercial, where my interest rate is, we'll just say 10%. But if you default on the loan,
it's 20.
My interest rate now goes up to 20. So you can collect those interest payments, even though you're not getting them.
And your attorney fees.
But at the end, you're collecting them because, it's adding up as you're not paying for them. But by law, you cannot take in more than you're owed. So if there was anything extra, that still has to go back to the borrower.
Nice. Great question.
Good question.
Yes, and if you guys have more questions about those specifics, feel free to reach out to Bill and Wendy, personally after the presentation. This is a good one. Kind of came in whenever you were talking about building your network, but where could I potentially find a real estate mentor? What type of advice do you have there?
Wendy.
Well, I don't know.
I'll let you answer that.
I hear Wendy Sweet at Carolina Hard Money's pretty good, but there's that is a great question. And there's a lot of people out there that are selling education that aren't doing it anymore. It doesn't mean they're not any good. It may mean that they're not up to date with what's going on. If you are a member of a local real estate investor group, they have speakers there, and you get a great opportunity to hear from that person, learn what they're doing, and check them out to see if that's somebody that you would want to know. I would go to biggerpockets.com. That's a great website to hit. They can suggest coaches and mentors and people that are in the business. It's also a great way to learn who you shouldn't be dealing with when you put names out there. So it's a good option. Those are all good options.
Mm-hmm. Yes, and subtle, not so subtle plug, be sure to join us for the Quest virtual happy hours. We get a lot of experienced investors that are joining us at those events, and it's really awesome. We haven't really marketed it any, specially at all, but it's attracted really high quality investors from pretty much all over. So Sarah, be sure to put that link in there just one more time. That is a great resource.
Haley, I have a question for you real quick.
Yes.
On your happy hours, are you providing in advance some recipes and perhaps having a mixologist come on and teach people how to make a drink?
That is a fantastic idea. We have not done that yet. I usually go pretty casual with my glass of boxed wine.
Hey, a box of wine is underrated.
Hey, you know what? Got to go with the economical option, right? Totally off topic here. But no, Bill, that's a great idea. If you know a mixologist, let me know. Maybe we can plan something.
All right, awesome.
All right, let's see. So someone here has a question about your fund. How long has this fund been active? How do you choose the markets that you lend in? Tell us a little bit more about that. Obviously we're not here to pitch investments or anything like that, but I do think it is an educational topic that we could touch on a little bit.
Absolutely.
Sure. So how do we choose the markets? Well, we're a little bit different from most. We're not trying to lend all over the United States. We decided that we want to know our backyard and understand our market, and that's where we lend. We're in the Southeast. We're in the Carolinas mainly, but we'll lend in the states that touch the Carolinas as well. And I think if you're going to invest in any fund, that you do it with people that know the local markets. There are really good funds that lend nationally, but they have feet on the ground in those areas where they lend. If everything is done out of one central office, you might want to reconsider. And we've had our fund since 2014.
Mm-hmm. Nice. And then it actually kind of leads me right into the next question. Can you spend some time discussing how you decided to create an investment fund? Also, how did you go about reviewing and accessing your back office and administrative needs?
That's awesome. I'd like to dive in on some of that. So the real reason why we started a fund is because we had $23 million of other people's money. And it was a crazy thing to try and keep up with all of the different lenders, because we'd have one lender that would have one IRA person that would have 50,000 in their bank or in their account, and another one would have 75, and would have to put them together in first position to be able to do the note. Now we still do that, but it really got to be hairy accounting wise. Well,
not just that. It took up a lot of time.
Yeah.
Trying to put all the pieces of the puzzles together.
Yeah,
it just made more sense to pool all these funds and have them there available. Plus,
it was safer for the investor to go into.
It's less risky for the investor because, like we talked about before, you have a large chunk of change and associated with one asset, where you can have your investment dollars now be distributed over 150, 200 loans. So it makes a lot more sense.
So if one went bad, you're not going to notice that it went bad.
Talk about the back office.
Because you have all of that to take up for it. So back office, gosh, I'm assuming they're questioning about, who would we have in place that underwrites loans and and underwrites the borrowers, making sure that we're doing our due diligence. That's really our back office part.
Right.
Now, of course, we have incredible accounting people. We don't really speak accounting, so it's a different language.
Our fund in general, we have a third-party fund administrator that keeps all the books. We also chose to have a accounting firm that does the tax returns for the fund and a separate accounting firm that does the audits for the fund. So,
right.
In our particular case, we have 3 sets of eyes with keeping with all the books. And if you're going to start your own fund, I suggest you get a third-party administrator to do the fund bookkeeping, and you concentrate on making the good investments for your investors.
The underwriting side, making sure that the borrowers can repay you, making sure that they can get refinanced out of a property in case they can't sell it, and making sure that the property itself is refinanceable and saleable.
Awesome. Great information there, and kind of gives me an idea for maybe a follow-up class as well, because the back office side of things is something we don't really dive into as much in our classes, but is so important for investors that are building their business out there. So whoever asked that question, thanks for the idea, and it was a great question there. Just 2 more questions, at least for right now. This is a good one from Jeff. Jeff wants to know, how could someone with a Roth IRA, maybe as small as $10,000, get involved with hard money lending?
Well, we talked about partnering. Go ahead.
That's right. So you can partner with another person that has money in their self-directed IRA, or even if they have cash that they're willing to lend, or if you have cash, Jeff, that you'd like to put together with your self-directed IRA, you can do that as well. You just can't touch your money with the self-directed IRA. You're like your borrower would have to write 2 checks, one to you for your cash and the other one that would go directly into your self-directed IRA. So
Correct.
It's available out there. There's other ways of doing it too. Not everybody wants to borrow more than $10,000. We do. I do short-term vacation rentals, Airbnbs, and I might borrow $10,000 from somebody that can finance the deposit for an apartment, saying I'm arbitraging it, that somebody else owns it, but I'm going to rent that apartment. So I need a deposit for it, and I need money for furniture and things to get that started. So they may be able to lend money to my LLC that's doing that business. So there's all sorts of ways to. I know people that are lending to pay taxes, that lending to investors that need to pay their tax bill at the end of the year.
And I was going to say, on the fund side of things, we have investors in our fund. The minimum is $50,000.
Right.
But they have 4 or 5 different accounts. And they're they have a different amount in each one, but they're all invested in the same fund.
Right.
So if you have a small dollar amount one account, you can always make up the difference with another account.
Right.
If you're an accredited investor and you're wanting to get into a fund, and I think most fund managers will take that as long as it all totals up to be the full amount. It's a little bit of extra work for them, but they usually want to work with you.
Right.
Hey, yeah, it makes the titling a little bit long, but you have the ability to use those multiple IRAs together. So, and I did just put this in the chat, but if you guys have questions about maybe how to maximize those accounts, if you only have one Roth IRA and you're looking at maybe making contributions to more types of accounts, you can still max out your 2020 contributions up until the tax filing deadline. So reach out to someone at Quest. We can help to walk you through those things. So, if you only have $10,000 in there now, there's definitely many ways that you could potentially get up to that amount that you might be looking to invest with.
Absolutely.
Awesome. All right, last question, at least for right now, unless a bunch just come pouring in, but we won't keep you here all day, no worries. Is there typically a minimum amount required to participate as a private lender along a more experienced lender? Kind of similar question, just phrased a little bit differently.
I'm sorry, I was busy reading someone else's question. Could you repeat that?
No, and I didn't. I'm not sure I understood the purchase part.
Yeah, like say if someone, is there typically a minimum amount required to participate as a private lender, maybe if I'm looking to partner with a more experienced lender?
Well, we're going to give you the attorney answer. It depends. Listen, there are plenty of people that, again, and we're talking about doing this to learn how to earn while you learn, so to speak.
Mhm.
So if you're looking for a mentor, that's one of the things that, we always teach. If you're new at this, find somebody where you can just invest a small dollar amount with that person and go on that journey with them.
Mhm.
And that's the best way to do it. There's no minimum amount. It just depends on how much they need to make the deal work.
And they'll find those people in your virtual cocktail hours. That's a great way to meet other people that are interested in doing what you're doing and that are doing what you want to do. It's a great way to meet.
Along with a future way of learning how to make new drinks.
That's right.
Yes, stay tuned. We'll have to do that. We'll call it the Bill Fairman mixology class. We'll name a drink after you. Awesome. So that's actually all of the questions that we have for today. So this has been super helpful. I hope all of our attendees out there have enjoyed the content that you guys have offered. But before we sign off, do you have any last kind of closing thoughts or information, advice for our attendees out there before you sign off for the day?
Well, my advice for anyone in an IRA is don't let that money sit around.
That's right.
What I said at the beginning, the best part of self-directed IRA is that you get to self-direct it. The hardest thing of a self-directed IRA is that you have to self-direct it. And I realize it's hard to figure out what direction to go with your investment, but you have to pull the trigger. It's not doing you any good sitting there not making any money. So get educated, do something that is fits your personality the best and your risk profile. And you don't have to throw all your money into something. Dip your toe into a few things.
Yeah.
And see which best fits you.
And Haley, we're really happy to participate in teaching the back office. That's something that I think we're really, really good at. And that's what makes you successful. That's what gives you the return when you treat that back office correct. So we'd be happy to do a class on that for you as well.
Perfect. Awesome. You know the drill. Katie will reach out. We'll get you scheduled.
Right.
We'll get it all done. But yes, I think that sounds like a great idea as well. And thank you so much for joining us here today. If we can put, what was your contact information one more time? We'll throw it down in the chat for everyone out there. It was something.
CarolinaHardMoney.com.
I should know this by now, but guys, be sure to go.
And then our email address is either Bill at or Wendy at.
CarolinaHardMoney.com. All right, guys, so thank you so much for joining us today. Be sure to check out our other events and webinars that we have coming up this week. Our virtual happy hour is next week, February 3rd at Wednesday at 6:30 p.m. Central Time. So be sure to join us. Be sure to check out our other resources. And as always, if you have questions, feel free to reach out to us, reach out to an IRA specialist, give us a call, visit our website. We are super easy to get a hold of. So Bill, Wendy, thank you so much for your time today. I hope you'll have a fantastic rest of your week, and I'm sure I'll see you sometime soon.
Awesome.
You do the same. It was a pleasure.
Always is.
Awesome. Y'all have a good one. See ya.
You too.
Where's my mouse?
That's the one thing I don't like about Zoom.